Hi everyone, we're going to make a start. I'm hoping you can all see my screen. Let me know if you can and I will fix it. So firstly, welcome to our Exit Strategy webinar. I'm Chloe and I head up our marketing at 360. I'm joined by my colleague Sean Maloney and also today's guest, we've got Nasim Sharf from Wilkin Chapman and private investors Richard, Pennack and Steve Rooms. So these guys are going to be hosting the webinar for us today. So I'll pass you over to Sean, first of all, to introduce himself.
Good afternoon, everyone, and thank you, Chloe. Yes, as Chloe said, I'm Chloe's colleague at 360, and I tend to look after a lot of our corporate finance type transactions within the business, which will involve exits and also acquisitions. We've put on this webinar because this is something we've definitely seen more and more of as we've gone on, particularly since the last 12 months have hit.
Thank you, Sean. I'll go to the next person on my screen, which is Richard.
Oh, hi there. Thank you, Chloe. Yeah, so brief introduction about myself. I've been a business owner for 20 odd years after a career in the city, and I've been a full-time, if you like, SME investor, business investor since my last exit in 2016.
Thank you. Nasim?
Hi everyone, I'm Nasim Sharf. I'm a corporate solicitor with Wilkin Chapman. We've got an office in Beverley, and there are three of us who do corporate deals, including exits. We're part of a larger company, and there's about 14 of us in our team who deal with these kind of transactions.
Thank you. And lastly, Steve. You're on mute still, Steve.
To apologise. Yep, I'm Steve Rooms. I'm a private investor like Richard. My background is in finance, so I own a number of companies in the local area. And I've been involved, my most recent acquisition's been back in September. I'm looking to close a couple of deals by the next sort of 6 weeks.
Okay, perfect. Thank you. Thank you all. So if you, any of our guests have any questions, just drop them in the Q&A box or the chat box. I've got them open on my screen to keep an eye on them. And this will be recorded and onto our YouTube channel tomorrow or Friday. And you'll also receive a link to your email address as well and a copy of the presentation. So I'll start by handing over first of all to Sean. Go to the first slide.
Thanks, Chloe. Yeah, and thank you, everyone. Thanks for attending. As I said, what's prompted this sort of webinar is the kind of events of the last 12 months where people are definitely looking, and business owners are looking at their business in a lot greater detail, particularly in the light of what do I do next? Do I want to actually do this, or do I want to make my business a better place to be for the future, and then ultimately look for a sale? So as I've shown on the slides, I'm going to just break it down into three kind of sections. The first section is looking to tackle a strategy. The second section would be what we would kind of expect to present to guys like Richard and Steve in terms of a vendor pack. And thirdly, it'll just a little bit about the taxation aspects post sale and a couple of things to look out for. As Chloe said, happy to take questions as we go along. The presentation will be a little bit of headline without any major detail, but if anyone's got any detailed questions that we can't answer directly on the webinar, then you can always contact any of us afterwards, and all our contact details should be on there. So if you could just move on to the next slide, please, Chloe. So to start off with tackling the strategy, I guess for the key to everything for me, my experience and my personal point of view is finding out what the end goal that you want to arrive at. So kind of working backwards, you know, finding out where you want to be, what you want to get from exiting the business, and then what do you have to do to actually arrive at that sort of expectation. So a number of key actions that I've kind of identified. I guess the first thing to do is really consider, as I said, what your financial requirement is. You know, the end of the business means ultimately the end of some of the remuneration that people are taking. How do you foresee what you'd like to do afterwards, post sale, and what do you need to do to fund that? And I guess the key for us is to start off with a valuation where your business is at the moment, and see where you actually stand. And that way you can get a good idea of where you are in terms of arriving at your end goal, how far apart you are, and what you need to do to get there. I guess for the valuation, and I know this will be possibly something that Steve and Richard pick up when they do their slot. There's a number of ways that an SME kind of looks at evaluating the business, but for us there's two kind of key elements, two distinct elements, and one would be the net assets of the business, which would be where what's left outside of the business. You know, what assets have you got over your liabilities? And secondly would be what we'd class as sustainable profits. Sustainable profits being what would a normal profit level be from your entity if you remove all the exceptional costs or income that you have in a year, and come to what's called an EBITDA, which is an earnings before interest, taxation, depreciation and amortization. That's generally what is used as the basis of putting together a model for your multiple of profits to value your business. And it tends to be an average over the last 3 financial years, but generally backed up by current management information. You have it to make sure it still holds true. And secondly, what we normally look at is formulate who your ideal buyer would be. Is that an internal person? Have you got a team that would look at this, or external, as we've got Richard and Steve on? What kind of external buyer do you want to take on your business? A lot of SME owners have an idea of that the business will carry on beyond them, a legacy. A lot of those businesses started up from generational stuff. So it's key to identify the correct buyer to the business that you want to have to really carry on what's going on with the business. You also need to look at the timescales. What's your expectations of timescales? If you're looking to exit tomorrow, then unless Nasim can work his magic, you probably have no chance of doing it in that sort of timescale. But definitely set aside a timescale of where you see your exit strategy to be, which helps you define the kind of measures you need to take in place, or even to refine your strategy to get to that place. And the last bit of the key actions on the first section is on the objectives, is what are you going to do post sale? What sort of income you need post sale? Do you want the funds to be sat in cash so it's liquid, or do you want to invest the monies so you have an income but expect some growth? So all those are really key actions to look at before you delve into any sort of strategy, is to try and find out what your end goal is and how to get there. Certainly looking to position the business to run without a certain owner principle always does help when people are looking at the value of your business or actually investing in the business. So creating some sort of internal expertise or using external resources to remove that the reliance on the one person within the business is also a fantastic key to getting your business ready for an exit, and making sure you have the right strategy. Again, looking at the reliance on one aspect of revenue or one particular large customer, if at all possible. If you can look to diversify your portfolio or your customer range, so to minimise your risk. Again, that's another strategy to look at, particularly when it comes to making your business saleable. And one of the keys really is making sure you understand your numbers, both current and future, if you're looking to do projections, which is something that will be critical to any investor looking at you. If you understand that and they know that you know the business, anything that you put out in terms of information or explanations how the business run always increases an investor's or a buyer's confidence the numbers that you're putting out and how you're looking to run a business, and really gives you a credence when you're looking to sell. So real keys to kind of doing that strategy is making sure that everything, as I said, can be run without your reliance. Are your RT systems up to date? Are you using the right tech? Even going down to, are you fully insured? Anything that where somebody be taking over your business, it just gives that confidence that if someone actually buys it, running the business in the sort of way it is or looking to grow it, it makes it easy as possible. Will always increase the saleability of a business and hopefully help you to maximize what sort of value you can get. Next slide, please, Chloe. So looking at what we would call a vendor pack or information memorandum, as it's normally known, we would tend to look at certain measures to let people know about the opportunity. To begin with, whether it's a targeted approach to specific buyers, or if you're just going to the market in general, we would always advocate preparing a taster document. A taster document, as you probably can tell from the wording, it's about a brief summary of the offering and some of the USPs of what your company or what your business has. And it's normally done to either whet the appetite of any speculative buyers or to increase the potential of any targeted buyers that you've approached to make you more attractive. And generally following up after that, we would prepare a more detailed pack, as I said, the information memorandum, and that then goes a lot behind the business itself outside of the taster document, generally containing a raft of information, financially, historic, current and projected information. Staff details is also key in terms of how the business runs, who are the key staff members, length of service, remuneration packages. Really important to have that sort of detail available for anybody looking to buy your business. A list of your main customers and suppliers, again to emphasise the main people that you deal with and whether you're reliant on one sort of customer base or one sort of supplier. An idea of your revenue streams and the kind of margins that you can produce from those. And generally, a lot of packs we include a SWOT analysis of strengths, weaknesses, opportunities and threats, again to give more understanding to anyone looking to buy the business, to see the areas where you have got some weaknesses or definitely where there's growth potential or opportunities, to look at things. All of this information, as I've said there, once the taster document and someone's made an approach to you, it should be really divulged only once non-disclosure agreements are signed, just to protect both you and the buyer. It's something that really must be done before you release any of this sort of information. Then following this, if there's a further interest, what normally happens after that is an amount of due diligence, which is further checking of information, and this tends to need more support from us from an accounting point of view, and from Nasim from a legal point of view. Again, it's a number of questions that any buyer would tend to ask and expect you to provide if you're looking to sell, to make sure, again, you understand the business, your business is on a correct footing to make sure that when a purchase is made, that there's no liability that's hidden within there. Next slide, please, Chloe. So now I'm just going to take you through a couple of the taxation aspects. One of a share sale. So this is if you sell the business as an entire entity. So if you're selling the shares of the business rather than just the assets, there tends to be a couple of ways where the sale is structured. So you've got a payment structure sent, and you normally agree a final consideration or price in plain English. Normally can be within three aspects. One, initial price, which is either the full amount or it can be a percentage of the total. Second is then a deferred consideration, which is the remainder of the price over an agreed length of time, which is normally set between you and the buyer. And can also be an earn-out clause that some contracts can have in place, which is a conditional amount depending on certain financial goals being met. As you can see, it falls into two parts. Ascertainable, which is a fixed amount based on events that have occurred, and unascertainable, which cannot be calculated at the date of the completion, but tends to have an estimated amount in there just to have some word in the contract. Next slide, please, Chloe. So in terms of a tax, the taxation on a share sale, what happens with the share sale is this falls under capital gains tax, but only if the company is a trading entity, not an investment company. So there's a distinction between the two, and the taxation is available on the total net consideration. So whether it's not how you receive your money, it's the full amount that's agreed in the contract after fees have been deducted. And as you can see, the taxation falls under your personal allowance, where you get 12,300 tax-free, and then the remainder after that is covered under the business asset disposal relief, called BAD relief for short. It's formerly entrepreneurs relief, and that's up to £1 million, and the tax on that is 10%. But this is a lifetime amount. It's not a transactional limit. It was £10 million a year or so ago, but that's been pulled back, stripped back in the budget. If you're looking to get beyond that, then any capital gains tax at this level will be at 20%. So just as I've said, in items to watch out for, it's based on the entire transaction, not on the time basis, and you need to factor that in with the cash flow when you're exiting, because with the initial consideration, you are going to pay some tax up front. It goes on the personal tax return, and it falls within whatever the personal tax year is. So from the 6th of April to the 5th of April, and whenever the completion falls, that's when the tax falls within that tax year, and generally payments by the January the following year. If there happens to be an event where the deferred consideration changes, or some of the deal changes so that the full price gets reduced, then you can actually reclaim any tax that's overpaid. And I've just put on a little bit, some instances with the more complex deals, there can be shares or loan notes forming part of the deal, which are called a paper transaction, and that has just some different taxation impacts. But if anyone wants a bit more detail on that, then obviously you can direct message me or contact me after this webinar. Next slide, please, Chloe. So the slight change to so the other aspect of selling your company can be via an asset sale, essentially selling the stock, the fixed assets, or the kind of goodwill of the business rather than the shares of the business. And that's taxed slightly different. If you've got this in with a limited company, then this falls within the normal, as the company assets, this falls within the corporation tax regime with the company, which is 19%, and that would fall in line with your company year end rather than the personal tax year end. Tax is payable as with normal corporation tax, which is 9 months and a day following the year end. If you then get to a stage where you want to close down the company and take anything left out, you've got to then do what's called a members voluntary liquidation, or MVL for short, which if it's below 25,000, you can just do that straight away. But if the net assets of the business are over 25,000, you have to get a liquidator involved. And if that's the case, then the taxation then follows what I've just mentioned on the previous slides, which is the share sale aspects. It falls within personal tax regimes now. Next slide, please, Chloe. So that's kind of my whistle-stop tour of the accounting side of it. As I've said, the key is to decide a course of action and discuss it with advisors, and then look at implementing steps. There are a couple of things you can look at from the tax side in terms of mitigating any tax losses. Definitely in terms of if you're doing this as an asset sale and it sits within the company, you can look at whether you need to make any pension contributions before you sell, before you wind up the company, or even after the share sale, the assets certain investments you can put money into, which will defer some of your corporate capital gains tax. I guess with that side of it, there's a lot of the trade-off is your liquidity versus your risk, because some of these additional investments you can make will reduce your tax, but they do come with risks attached. So that's my final bit. As I say at the last bit, if you're already at this stage, the next call to action would be to identify the ideal buyer and enter into dialogue, particularly with an open mind, because it is a negotiation at the end of the day, and definitely get some good financial and particularly some good legal support. So I guess that nicely comes on to Nasim.
Thanks, Sean. Chloe, could you just move that on? Another one, please. And another one. I don't think people want to see that particularly. And then we can move on from that one, please. A bit like Sean, I've put a bit of detail into these slides because I anticipated that people might want to look at them afterwards. I've tried to simplify what is quite a complicated process, really. I always think if you can remember 2 or 3 things from any of these talks, then you're doing pretty well. So what I've done is set out a sort of 4-pillared set of basics, which I'll just talk about for the next 10 or 15 minutes. And I've used this acronym TILT: teamwork, investment, legals, and tax. Chloe, can you just move on to the next one? So the fact that there are there's Sean and 3 guest speakers on this talk gives you an idea that really these deals do need to be a team effort. This is my team, Hull City. I was hoping this would be a celebration of promotion today, but that'll have to sort of happen on another day. The essence of a team, of course, is that you've got several individuals and each of them are good at different things, and you end up being better off than trying to sort of muddle through yourself. Chloe, can you move on to the next one, please? So the question is, well, who do you want on your team? And certainly you're going to have your accountant. I would recommend that you use somebody with corporate finance expertise. Now, Sean's got that, but also Steve and Richard have got that. And the reason why you should consider seriously using somebody with expertise in the corporate finance sphere is because they're in the marketplace, so they know what deals are being done, not only the price that you might get for your business, but also what's out there in terms of financing of deals. And although I do deals every day of the week, I wouldn't begin to pretend that I understand what's out there in terms of market knowledge. So that can be very helpful. Obviously keep your banker on side, but the other thing is chat to people, chat to your contacts, especially if they've been through a process themselves. I always tell people that you won't believe how much work is involved in doing a deal. People never quite believe it, even though I've warned them. And leading on to that, seriously consider involving people within your organisation. Sean mentioned putting together the vendor pack or the information memorandum. There's a lot of work in that. And then once you're into the deal itself, there's a tremendous amount of legwork as well. So many hands make light work. So if you can involve people within your organisation, then that will take a lot of pressure off, because don't forget, you're going to have to be carrying on your day job at the same time as running this, this sort of massive transaction. And a lot of people, they only sell their business once. And then tax advice is obviously important, and you wouldn't be surprised to learn that I'd sort of recommend that you involve the corporate solicitor as well. Can you move it on, please, Chloe? Thanks very much. So the second pillar of the TILT framework is investment. And by this, I don't mean spending money. I mean spending time. I've put make friends, form a team. I put my contact details at the beginning of this slide. I'm somebody you could talk to, Sean's somebody you could talk to, and Richard and Steve are people you can talk to. But there are other people as well. You know, the more you can find out about the process, the better. And the earlier you start thinking about things, the better. There are things that can be done earlier on, which later on in a deal are no longer possible. Sean mentioned the word risk. A lot of corporate deals are around risk and managing that risk on the sell side as well as the buy side. During the course of the process, every element of your business will get scrutinized. So there are things that you can do at an early stage, formalizing contracts, making sure that your employee arrangements are up to date, all the modern stuff, GDPR and all of that. Just you can get that sorted out, and it just means that when you go into the process, you're in reasonable order, and you don't really want to be knocked onto the back foot when you're selling by things which can spook the buyer sometimes. You just want to sort of appear like you've run your business well. It's slightly artificial, but that's the sort of game. That's the game we play. Sean mentioned aspirations, which is what you might want, but you also need to invest time in understanding what you can achieve, and that involves an element of realism. And again, corporate financiers are very valuable for helping sellers understand what can be achieved. Many people think they can sell their business in one go and get a massive check and then just disappear. Really, most of the deals I do now, they have an element of what Sean mentioned, which is deferred consideration, which is you get a bit on completion, but you get some further down the line. By looking at things at an early stage, there's also things that you can tidy up. It might be that you've made profits and you've bought investment properties. It might be that you've got some key managers and you want to incentivize them to be part of the exit. Sean mentioned entrepreneurs relief. That used to be very valuable. It used to be worth up to £1 million in tax savings. It's now worth only up to £100,000 in tax savings per person, but it is per person. So if you're married, your spouse has that. If you've got children, they've got that. It's possible to take steps a couple of years before you sell, which would increase your entrepreneur's relief and could save you several hundreds of thousands of pounds without really impacting your family in an adverse way. And then you've got to think about yourself. What am I going to stay on? And again, the interaction with the corporate finance and your accountants and your other team will help you with this. It might be that you want to sell and disappear into the sunset, but the reality is, if you're going to maximize the value, you're going to have to stay on, at least on a transitional basis. We'll have the next slide, please, Chloe. So the L of tilt is the legals. There's three elements to this that I'm going to briefly talk about. One is, what's the nature of the deal? And as Sean mentioned, there are two main ways of selling your business. One is an asset sale, which if you're within a company means selling and then paying corporation tax, then paying another load of tax when you get the cash out of the company. The other is selling the shares itself. And then common to both of those ways of selling is the legal process. Can we have the next slide, please, Chloe? Okay, so an asset sale, this is sometimes called a business sale, which is slightly confusing because you think, well, if I'm selling my shares, I'm selling a business, but it's just terminology which has sort of taken a hold. The essence of an asset sale is the buyer is buying identified assets and taking on certain liabilities. So that might be freehold premises, it might be it might be equipment, it might be stock, and if you've built up a profitable business, it will be goodwill, which isn't an asset you can touch, but which is an asset nonetheless because it's got some value to it. As assets are being bought, there's less risk than in a share sale. In particular, the buyer doesn't take on the tax history of the business so much. Tax can be a problem for some business sales, in particular if lifestyle expenditure has been taken out of the business. And I've had several deals that have fallen over because the lifestyle expenditure has just been too obvious and too large. You know, I had one deal where the seller had taken his family to Richard Branson's island. Now, you know, once you gross that up for national insurance and PAYE, you effectively double the value of the benefit that's been taken out. So it doesn't take long before those kind of things can become a problem. And if you've been having lifestyle expenditure out of the company, if you're thinking about selling, that's one of the things that you might consider tidying up. One thing you can't avoid by buying assets is employee liabilities. So there's a special legal rule which people might have heard of called TUPE, which means that if you buy a business and there are employees in that business, fundamentally you have to take those on under the same terms. Can we have the next slide, please? So share sales, most of the deals I do are share sales, and sellers often prefer share sales because there's one layer of tax. But there's one big point about share sales. Next slide, please. And that is, when you buy the shares in a company, you're buying everything that exists within the company. And if you do a deal with me, I will use this phrase because I lack imagination, but I think it sort of captures it. You take on the good, the bad, and the ugly. So you've got all of those good assets and that goodwill, but you've also got problems, and you might have just things which are sort of downright difficult and need dealing with. So can we have the next slide, please? So the way to manage the risk around the good, the bad, and the ugly is by the buyer following a particular process. Sean's touched on some of these. In particular, before you share any information, you should get a confidentiality letter, or sometimes called an NDA, or non-disclosure agreement. All of that good stuff that Sean mentioned gets you to a point where heads of terms are agreed. Now that's just legal speak for the overall terms of a deal in a non-binding way. Following on from the heads of terms, there's then the key document is the business purchase agreement, or if it's a share sale, the share purchase agreement. The main way that a buyer will protect itself is by requesting warranties in the business purchase agreement or share purchase agreement. And those are statements which the sellers are expected to stand behind. For example, it might say that there hasn't been a dispute with an employee in the last 3 months. Now that might or might not be true. The purpose of the warranties is twofold. One is, if the warranties are untrue, then the buyer has bought something which is worth less than they thought it was, and that will entitle the buyer probably to get some of their money back. The second element is to elicit more information about the business. Although they will have conducted their own due diligence process, as Sean mentioned, they will want that to be firmed up by disclosures to be made against the warranties. And a disclosure is simply a statement which explains how a warranty is untrue. So for example, coming back to the warranty about an employee, somebody might have left. They might have claimed that they've been unfairly dismissed. And the way that the sellers would protect themselves in relation to that would be to disclose Mr. X has left. These were all of the circumstances. He thinks it's unfair, we don't. And he said he's bringing an employment tribunal claim. There will then be the negotiation of all of the documents, and when those have all been agreed, the deal will be consummated, and that's called completion. Next slide, please. The final limb of the tilt four-pillared approach is the tax. Many people think that they're automatically entitled to a 10% tax rate when they sell their business. That is not the case. As Sean mentioned, the 10% rate arises because of the availability of entrepreneurs' relief. That was renamed last year, as Sean said, business asset disposal relief or BAD relief. You get an idea of what the government thinks about entrepreneurs' relief, because there was absolutely no need for them to change the name. So, you know, they'll have been having a snigger at that around Downing Street. Sean mentioned that the availability of entrepreneurs' relief went down from 10 million to 1 million, and at the 10% rate, that's how you get down to the 100% potential saving that I mentioned earlier. That is a significant reduction. Obviously, you know, it's been reduced by a tenth of what it was, 90% reduction. There's talk of increasing the rate of CGT. I think it's likely that it will happen at some point. We had several deals that completed before the last budget because of the anxiety about the increase in CGT rates. That anxiety will continue until they actually go up at some point. The second point about taxes, if you've got key employees and you want to give them a bonus, quite often at the last minute, people will say, I want to pay this employee a certain level of bonus. That's fine, but there will be things that we could have done earlier on in the process, which means that that could have been dealt with in a much more tax efficient way, not only for the employee, but also for the company or business that is being sold. And then the last element of the tax part is not all sales of shares, even though they're actually a disposable of capital asset, are treated as though it's a capital gain. This is relevant particularly if not all of the shares are being sold. If you could imagine a simple scenario where a company's made, say, £1 million worth of profits, and then rather than take that out as a dividend, a new company is formed and those shares are sold to the company. The sale of those shares is actually a capital transaction, but there are tax rules which say, well, hang on a minute, you could have had that as a dividend. That can be dealt with because there are tax clearances that can be obtained, but also if you get advice, it should be possible to structure deals so that you don't fall foul of those rules. Okay. On to Steve and Richard then, please.
Right, so we can go through, Chloe, to just after our profiles. Great. Okay, one of the key things that as investors we want to understand are the motivations for selling. There are a number of reasons, as we've put onto the slide here, as to why somebody might want to sell and in what time frame they might want to sell. Sometimes people think as investors, we're only really interested in acquiring the business. Well, no, we want to understand the seller. We want to build that relationship with the seller as well, because as Taz has just alluded to, we quite often want to retain the sellers for a period of time to enable a handover, a smooth handover. Everybody wants the business to succeed. Quite often when we speak with sellers, it's more about legacy than it is about cash. Quite often, you know, Richard may well say the same thing. So it's very, very important that we understand why the business is to be sold or divested, and what a good exit for the seller looks like. It may be retirement, it could be It could be ill health. It could be poor business performance. Is the business distressed? Is it that the seller has a number of businesses within their portfolio, or the business in question is non-core, considered non-core, and they're looking to divest? So there's a number of reasons why we would look at the reasons for the sale, and then start to understand the sellers and the business itself. Next slide, please, Floyd.
So yeah, just following on from Steve there. So well, I'm from NAS as well. There's usually quite a defined process that happens with regards to due diligence, and from a buyer's perspective. And a lot of buyers, certainly if they're trade buyers, will look for synergies and businesses that fit certain criteria that will help their existing companies or group of companies expand into new markets or sectors, or integrate vertically or horizontally. And if that acquisition profile fits your company, then they might solicit an approach to you, either through an intermediary or through a letter, or LinkedIn or some other kind of platform. Or if you are, if you do engage the services of a broker or your accountant or corporate financial advisors to reach out to the wider industry, then they might be an interested party which they'll put you in contact with. But essentially, it's all the same thing. Once a buyer is interested in your company, they'll follow a very straightforward process, and it's really a sense of is that company a good fit strategically? Is the management the right fit culturally? Does the financials of the business and the prospects of the business fit with what the buyer is looking for? And then once you kind of establish that, which usually happens over an initial call, then you'll get into the nitty-gritty, the kind of due diligence side of things, which is when you'll start producing the documents, the heads of terms, come to a kind of basic outline agreement. And then from that point on, you really start to drill down into the detail of, what your company does, what its liabilities are, what its outlook is, what the numbers say, where the, hopefully there's no skeletons in the closet, but if there are, you need to investigate that. And really that kind of forms part of that process, which again feeds into the ultimate negotiation on what the sale price would be that you could achieve for that business. Once you've agreed that, then it really is a case of the completion. Now, most private investors, business investors, will work with the vendor of that or the business owner, and they'll structure a deal which really fits their personal circumstances. It's not, it's not a one-size-fits-all approach. I think, Steve, you can correct me on this, but when it comes to business valuation, I think Harvard Business School recently published a report that said there's something like 127 ways of valuing a business, but ultimately what it comes down to is what somebody's prepared to pay for it. And there's certain metrics, the way that you can value a business, which Sean alluded to, which will be based on the potential for future profits and also the current assets or cash within the business, less any liabilities or potential liabilities. So like I say, it's not one size fits all way of doing this, but this is how a buyer would look at your business and ascertain the value, the financial value of that business, but also the strategic value of that business when thinking about acquiring it. Steve, if you can go to the next slide, please, Claire. I think, Steve, you can pick up.
Yeah, sure. So, we've touched on how we might structure a deal, and the deals that Richard and I tend to look at, there are up to 15 different ways, and people tend to think, it's something called a leverage buyout, but it could be so many more. There are so many more different ways that you might look at this. And again, it goes back to the circumstances which the seller find themselves in. Is the business semi-distressed, in which case could bring in someone like Richard and myself with a smaller stake, but agree certain performance criteria. Could that work? Because at the end of that process, you've got a business that's worth more, where you've had some expertise, put their input and their experience into the business, and then they're left with a better looking exit. There is the leverage buyout. There are distressed companies, distressed deals, but it really does go back to what situation does the business find itself in. Naz has touched on completion payments and deferred consideration. That is really coming down to the negotiations between the buyer and seller. You know, these days, particularly in the current climate, finance is harder to find at the moment. So there needs to be an acceptance, realization that no one will come along with a huge bag of cash and say, here you are, here's everything for you. They can happily sell into the sunset. We need to look at it differently. But again, the way that Richard and I would want to look at this is to structure a deal which is in the best interest not only of the seller but of the business as well. You know, we don't want to come in there and put a large amount of debt into the business, only to find that it fails. That doesn't help anybody. So it really is looking at the circumstances in which the business finds itself in. And going back to the IM point, the information memorandum that Sean mentioned at the start, have a look. You know, you need to understand what is in your balance sheet, and you need to be able to explain it. I've had a deal recently where the sellers couldn't explain what was in their own balance sheet. They even produced a balance sheet which didn't have any stock in it. You know, understand it, make sure you're as clean and it's as well prepared as it possibly can be. Okay, thanks, Chloe. Next slide, please.
So yeah, so just following on from that, really. So one of the biggest hurdles we come across with a business owner's perception of what their business is worth is, you know, going back to the Harvard Business School point earlier, is a lot of people unfortunately think their businesses are worth a lot more than what they are to an interested party, and then that's the reality is that, you know, an investor such as myself or Steve will look to invest in a company, whether that's time or capital or expertise or whatever, in order to improve the value of that company, improve its growth, its profitability, which ultimately improves its shareholder value. Now, the reason I say that is because valuation is quite a, it's not an exact science, it's more of an art. And what you tend to find is there's a thing called a liquidity gap, in the sense that when you've got a very small company, you know, kind of sub 5 million revenue, you know, sub £1 million EBITDA, the liquidity in buying and selling a company like that is a lot harder. So you can't sell that company very easily compared to, say, a FTSE 100 company where the shares are traded on the open market. So to give you a rough idea, you take a standard, I don't know, manufacturing, engineering company, industrial services company, they might be valued on, you know, a rough multiple of EBITDA of, say, 3 times profits or 3 times cash profits, you know, plus any cash or net assets, you know, depending on what type of business is. This is a very rough guide, and it's not, as I say, it's not an exact science, but if you then take a much larger engineering company or manufacturing business that's, say, listed on the stock exchange, you might get a valuation multiple of 15 or 20 times. And the only difference between those two companies, apart from the additional profits they make, is really how easy people can get in and out of that company with regards to liquidity. That is why larger companies with greater liquidity are worth more money. Now, what we try and do is we try and improve the balance sheet, improve the profitability of that company, so it is essentially worth more. And it's that old adage of you need to be big to get big. So a company with, you know, £500,000 or £1 million pounds profit might only be worth 3 times, but a company with 5 or 10 million pounds profit might be worth 6 to 8 times. And the bigger those companies get, the more interest and the more profit they make, the more interested or more interest you'll get from larger players, such as, you know, bigger competitors or private equity houses. But it also allows you, certainly these days as well, to start thinking about either a direct listing on the you know, smaller stock exchanges, or maybe merge that company with a much larger competitor who might open up international markets for you, or so on and so forth. So I digress slightly on the point, but I'm just trying to really emphasize the fact that small companies are only worth so much because of the buyer risk which is involved in turning them from a smaller company to a more profitable large company. So just touching on the point about EBITDA, business valuation is quite emotive. I'm sure Steve can back me up on this, but I tend to find that when we're talking to business owners, they have a figure in mind which they want to achieve. Now, that figure may not be, in essence, based on fact of what the financial performance of the business is. It more be based on their personal situation and whether they want to pay off a mortgage or buy a yacht or or whatever the situation might be. But in essence, all we can do as an investor or an acquirer of that company is look at the facts and the financial performance of that company and try and determine an accurate valuation for that company based on previous trading history and previous performance and profits. So I think once that's explained, and I'm sure if you talk to your accountant or your solicitor, there will be an element of realism in there of this is how a business is valued. And I think once that's understood, then it just really opens the dialogue to people like myself or Steve, who are very keen in investing in buying or improving well-managed, profitable companies with, say, established management, where that existing business owner can maybe look to exit in a very frictionless manner. Just going back to the valuation, I was slightly off piece here with regards to the valuation, but generally speaking, if you're looking at a multiple of, say, 3 times EBITDA, if your business makes, for example, £1 million of EBITDA, then we would look to start negotiation probably around the 3 million plus, maybe cash in the business or other assets such as IP, which may be factored into that equation. So, like I said earlier, there's lots and lots of different ways to structure an exit of a business. It really does depend on personal circumstances and situation you find yourself in. One thing I would say, actually, just touching on Naz's point earlier, is we generally look at share sales because that allows the business owner literally to walk away once the deal is completed. They can walk away. It's kind of somebody else's problem to deal with at that point, and providing they've been honest up to the point with the information they've provided, it usually allows them to walk away with a clear conscience and do what they want to do. So I think the key to remember, though, with regards to valuation is there's so many different ways of valuing a business. There's so many metrics. It's quite an emotive subject because business owners, and I know because I've been there myself, but business owners always think the business is worth, usually more than what somebody's prepared to pay for it. And there's usually a raft of reasons why that is. But ultimately, from our perspective, you can only look at the facts of the business and what assets it's got and what its financial performance is, and ascertain a stake in the ground valuation, after which common sense tends to be applied and negotiation comes into it with regards to finalizing any agreement and completing that sale. So next slide, Chloe, please.
Okay, we've touched on some of this earlier, but be as well prepared as you possibly can. If you can prepare an information memorandum ahead of any conversations with potential buyers, that's going to stand you in good stead because it helps smooth the process along. And that's what I'm really referring to by pre-pack the business. Can you prepare all the information? You could even prepare a data room ahead of any potential sale, and Nas touched on that as well. You've got your people such as Sean, who you can speak with, who you'll be able to ask advice of. You could engage a business broker, my pet subject, but you've got to be really beware of a business broker, in my experience, because you may pay an awful lot of fees up front, not necessarily get the results. So I think if you've got a good team of advisors such as a Sean or a Nas to work alongside you, I think you're better placed to get a more realistic valuation on your business and have a much smoother process. And just going back to the point of pre-packing, just try and make your business as attractive as possible and be honest about it as well. If there are issues in the business, you be honest about it and just say that. Because it may also be attractive in its own way to an investor, because they'll look at it and think, well, I've got other resources, I've got other companies where we can make an impact there. And again, just on the last point there, NASA's touched on this, and so has Sean on the BADR. So make sure you're aware of that and take full advantage of it. Okay, I think that's it from us, Chloe. I think that's our last slide, isn't it?
Yeah, thank you. Okay, so we've finished 5 minutes early, so that gives plenty of time for any questions. Nothing has come through as of yet, but if anyone that is still here, just pop the question in the Q&A box or the chat box.
Oh yeah, I've got a question for Nasim.
Okay.
This might be how long is a piece of string, but typically, any idea of a length of time a deal can take, Nas?
Well, I think from heads of terms to get into completion, you should allow about 10 weeks, I think. If there's a requirement to do it quicker, then things can be expedited. So it links back though to what Steve was saying. If you've prepared well, then it enables you to give the confidence to the buyer that they've seen, because it's just a process of investigation, really. If you leave aside the negotiation of the documents, if you've got solicitors on both sides who know what they're doing and they're being sensible, then you can agree the documentation quite quickly. But what you can't deal with is gaps in gaps in information. So or being able to respond to the impact of new information being made available. And again, it comes back to Steve's idea of being honest. Now, when I first started doing this about 20 years ago, people used to think they were clever by dropping bad news in at the last minute. It's, fortunately, people do not do that now. I don't really see that in deals at all. But if you have got some bad news, prepare early, either deal with it or be prepared to have it reflected in the price or deal with it in some other way to enable a buyer to proceed without feeling that they're taking on an unfair amount of risk given the price they're paying.
Yeah, I think that echoes what I've seen. I mean, getting heads in at terms as both Rich and Steve had in their slides, getting those nailed before it gets to you always helps speed up the process.
Yeah.
And just a question for Richard. Have you got a sweet spot where you kind of look, you're looking for acquisitions in that sort of area? What's kind of your sweet spot?
Yeah, we do really. I mean, it's we tend to find we can add most value with companies that kind of operate in that kind of $750,000 to probably 10 million revenue range. Whether EBITDA or their EBIT or PBIT is probably more than say 100, 150 to say $1 million. We tend to get maximum bang for the buck with the strategies and tactics that we employ to grow that business. And it's also when you get to the upper end of that threshold, and this is kind of sector agnostic as well to a degree because it works with most trading businesses. But I tend to invest in businesses with assets, and they tend to be manufacturing, engineering, industrial services, and so on and so forth. But what we tend to find is when you get above that 10 million revenue, you start to get into a different ball game with regards to mergers and acquisition strategies, and you'll start dealing with private equity houses and people like that, and it kind of changes the dynamic slightly. Can I just make a point earlier which I didn't cover, but this might be useful for both your client bases. But if you're finding that business owners are in either distressed or pre-distressed, there's usually quite a lot we can do to help nurture that business back to a profitable situation, and that's beneficial in a number of ways. But primarily, there's a lot of people who don't really understand the insolvency process, and they kind of get sucked in and tend to lose their shirts once they go down that path to a degree. But we have quite a lot of experience of turning those companies around so they're profitable and giving them an exit that they can actually benefit from. And I just think that after the year that everyone's kind of experienced, there might be a need for that, even if it's just a little bit of a, you know, a helping hand or just somebody to talk through the options. It's something that, you know, we'd be happy to do, as I'm sure you guys would do.
Right. Yeah. Is there any questions, Claire? I don't think there is there?
No questions, no. So we are on time, 5 o'clock exactly. So before we leave, so thank you to Sean, thank you to Nasim, and thank you to Richard and Steve. Steve's had to go. But to all the guests as well, obviously, thank you for joining us. We hope you found it useful. As I said at the beginning, you will get a copy of the presentation, which has got all the contact details for these guys on there, and also a link to our YouTube with the recording. Our next webinar will be in May. Not too sure on the topic as of yet, but keep an eye on the website and social media for more details on that. And yeah, that's it.
Yeah, I'd just like to say thanks to Naz and thanks to Rich and Steve. I mean, it's rare that you'll actually get an actual buyer that comes on here. So I think that's been really good insight for anybody looking to sell, what kind of buyer would be looking for. So thanks a lot for guesting. We really appreciate it.
You're welcome. Thank you all. Thanks for hosting.
Not a problem. Thank you. Thank you, everybody.